broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live as always from the CNBC-TV18 Motilal Oswal studios. It's a Tuesday morning. I'm Prashant. With me, my colleague Sonia and Nigel. Guys, hi, good morning.
Hi, good morning, Prashant. Good morning, Nigel.
Good morning.
Well, things have escalated across, the globe with respect to the geopolitical tensions, right, with Israel and Palestine. But for our own markets, I think global markets and India has shrugged off, at least so far, what's been happening. So perhaps the markets have moved on, but still there's a lot that's happening across the globe.
There is a lot which is happening, and I think we'll continue to take stock of course, the geopolitics of it. But, let's just quickly start with, the trade setup as always, right? Incrementally, the market did not react. I mean, the reaction was coming through in US futures, etc. But overnight, not very much. I'll get to that. By the way, yesterday, with that sharp fall on the Nifty, and by the way, the Nifty did end pretty much close to the low point of the day, about 20, 30 points off it. The Nifty gave back almost 50% of the rally since Wednesday's low. We were kind of putting that number out that the Nifty's gained 300 points from the Wednesday's low as to Friday's close. Yesterday, in a single session, 50% of those gains were given back. Now, overnight, we had a bit of a decent session. The S&P was up 0.63%. Pretty much all the sectoral constituents of the S&P 500 ended higher. The biggest gainer was the energy part of the complex, which actually ended about 3.5% in the green. It's a large weighted sector, the energy sector, and that has an outsized influence on what the index itself did. And of course, oil's seen that jump. It's trading at about around $88 a barrel at this point in time. Bond markets were shut for the Columbus Day holiday, so we didn't get a reaction in terms of the yields or what happened across the curve. But we had some commentary around bond yields and what that means. Now, when bond yields go higher, it essentially is yields are nothing but market interest rates, which trade, right? And then there is the Fed, which sets interest rates in the system. So when yields go up, it is market financial conditions tightening. And you had, a senior Fed official who came out and said that because yields have risen so much, it basically means financial tightening. I'm paraphrasing here and not exactly going by what he said exactly. He said the implication was that they may not require another rate hike. Markets are doing the job. The dollar rising, yields rising, all of that is financial conditions tightening in the system. And that is essentially what he alluded to. That did give sentiment a bit of a fillip, and that had a bit of an impact on what equities, etc. were doing. By the way, the dollar index was down about 0.25% at about just under 106 odd levels. So that is another plus that we are working with this morning. The near-term trigger for US, right? If you just go by data, the last data was a big blowout number. The jobs data, the headline number was a big blowout. The next one is CPI number 2 days from now. That is on Thursday. We'll get the US CPI, which is, I think, going to be the big trigger very, very near term. Remember, the market in the US did not react negatively because data was very strong. So perhaps the people are waiting for confirmation with the CPI, and that's why this becomes important. Now, tying all of this back to levels here, the Nifty Bank made a new low, but it was not confirmed by the Nifty. The new low for the Nifty Bank was 43,796. But the Nifty did not. And that's the reason why this morning I'm saying that I don't think all is lost in that sense, right? Even in the very near term. Because the market here was looking strong before the events over the weekend. And of course, then what happened over the weekend. Market sold off yesterday. And then we have the dissonance between Nifty and the Bank Nifty. Starting with the Bank Nifty, the big support stands at 43,345, which is the June lows, which is, by the way, not very far away, 1.5% or so on the Nifty Bank. That should not break on any downside which emerges. The Bank Nifty is clearly the weaker of the two indices. The resistance for the Nifty Bank comes in first around 44,400. There are multiple, basically the Nifty Bank has spent lots of time around that level. And then there is a technical level, which is the 40-day exponential moving average, which comes in at 44,677. Pretty close by, both those levels. But that's what the market needs to get past for things to really look up. For the Nifty, the low, which is 19,333, is the sacrosanct level, which should not break. It's about 200 points out from here. The resistance comes in at the 40-day exponential moving average, which is around the 19,605 level. I think with the bump that the GIFT Nifty is implying, we perhaps will open around those levels. So, it'll become a bit of a dilemma in terms of what you want to do. The broader markets, there you go, 70 points up move, and the GIFT Nifty is indicating a start around 19,611, which is where the 40-day exponential moving average is also at. You'd rather had a weaker kind of an opening, which gave you the opportunity, but you'll open right at that resistance line. So I would say, give it at least an hour before you decide to do anything. If momentum really builds up, and that you'll know by looking at the screen, you perhaps participate. Otherwise, give it some more time. Sonia.
Absolutely. I mean, the geopolitical tensions have escalated, right? There's no two ways about that. Of course, the market has chosen to decouple from it. But just to give a sense of what's happening, the battle is really intensified between the Hamas, groups and the Israeli troops at the moment. And it may have some sort of economic implications as well. So the latest we know is that the death toll is now over 1,500. Israel has mobilized over 300,000 of their reservists. Gaza is completely under siege. And what's happening in that part of the economy is also quite troubling. So the central bank in Israel has sold about $30 billion worth of foreign reserves, and the shekel has now hit a 7-year low. So yes, it is for now just restricted to what's happening in that part of the world, but that's something that you need to keep in sight. Having said all of that, as Prashant was mentioning, the market seems to have moved on, at least overnight. The GIFT Nifty is up, about 70-odd points, indicating a big positive start. The US market have shrugged off all the geopolitical concerns for now. But that's also because some positive commentary came in from the US Fed officials. So that resulted in the US markets ending in the green. The Fed vice chairman said that they would remain cognizant of the tightening in financial conditions because of higher bond yields in assessing the future path of policy rates. So there is an expectation that there could be another pause in rates because of the way the yields are moving, and that caused the US markets to move higher. Even in our own markets, we've pretty much shrugged off what's happened across the globe, which has been the case if you go by history as well. The Nifty is holding on to 19,500. There was large buying by domestic institutions yesterday. DI has bought over 2,600 odd crores, while FI sold less than about 1,000 odd crores or so. Tomorrow onwards, we get thick into the earnings season. So you have TCS's numbers tomorrow, Infosys and HCL Tech day after. Then over the next few days, on the 13th, there's HDFC Live, 14th, there's Avenue Supermarts, and 15th, there's HDFC Bank. And this will be the first, set of numbers post the merger. So we'll keep our eye out on HDFC Bank as well. But having said all of that, it's a dilemma, right, you're dealing with. On one hand, of course, geopolitical tensions and heartbreaking images. But on the other hand, the market, the core market has chosen to move on for now.
Well, Sonia, today, if you get a dip, the odds would be that you would make money if you get into it. And I'll tell you why. Because global reports are suggesting this morning that the Hamas group, they are willing to call a truce with Israel. Just around 2 or 3 hours ago, if you just Google, you'll see that various global reports are indicating that they're willing to come to the table and discuss. So de-escalation is something you're looking forward to. I'll read that as some part of de-escalation. The second point is the Fed officials, they're sounding more dovish than hawkish. And the third factor is the dollar index has cooled off. So this has the makings of a good session if, in fact, you get an intraday dip. The institutional flows yesterday, yesterday we got saved from the FI selling. Because you look at the gross flows, the gross FI numbers, well, they were 40% lower than what we have seen in comparison to the average of the last 10 days, which tells you that the FIs basically yesterday, they weren't really at full go, which is good news because the kind of cues that we had. And in fact, the gross participation was the lowest we saw since Easter Monday. That's since April 10th itself. Short point is, today I'll want to see what the FIs do. Will they come and sell even more? Or will they continue to hold back as they've been doing in the past week or so? The net institutional flows as well were the best. That's the FI and the DI number put it together. That was the best we saw all the way since 15th of September 2023. What do the FIs do though in the F&O market? Well, yesterday they added some shorts as well. And now the short positioning continues to hover around that 73% odd mark. In terms of the options data, the 19,500 put has the highest open interest on the put side. The premium yesterday went up to around 80 rupees from around the 35 rupees odd. Now, there was some addition out there. There was some sense of writing out there. But it appears, those writers as well were a little bit nervous because you didn't see a big open interest build up. However, the 19,600 call, aggressive writing is what we saw. There more than 30 lakh shares getting added. So what does the data points tell you? 19,500 put did see a fair bit of addition. So 19,450 becomes a crucial support zone. And yesterday's low as well, 19,480. So that's a support zone. On the upside, yesterday's high is around 19,590. That becomes a bit of a resistance zone. And also you have the 50 DMA that comes in at around that 19,600 odd mark. We're going to be starting off closer to that level. So you'll want to build on from there because we're going to be starting pat in that resistance zone. Today, you have the Nifty Financial Services weekly expiry that plays out. And you had a fair bit of writing at around the 19,600 call. The premium came down to around 30 rupees from around 100 rupees odd. So the 19,700 will be a bit of a hurdle. And that index could move in the final hour of trade. Keep in mind, the Nifty Bank has been underperforming, but today we're looking at the Nifty Financial Services Index. So that is the broad range we're looking at. SGX or the GIFT Nifty suggesting that you see a big gap up. I don't think you need to chase that gap up, but if you get an intraday dip, just going by all the cues you have, and hopefully there is de-escalation that we see in Israel, then in fact maybe today is a good day to get in at lower levels.
Okay, well, today could be a good day to get in at lower levels, buy on dips. That's something that, we have been talking about over the last 24 to 48 hours as well. Let's kickstart the show. Let me tell you what's lined up in the first half hour of the show today. We'll get you updates from the markets across the globe. Cameron Brand of EPFR Global will be joining in to discuss the global trade setup. Later, our research team will bring you CNBC-TV18's list of top 10 stocks for the day. At around 8:30 a.m., we'll do a fundamental stock analysis. We have Hemang Jani joining in. But first up, let's begin the day with some views on the equities front. Lawrence Belanco of CLSA says that following the July to September price momentum divergence, the Nifty has seen the correction break below its 20 and 50 DMA before finding support at the August lows around 19,230. A break below this support zone would open the door for a test of a major support zone at the 18,520 to 19,017 area, including the 200 DMA and the 2021 and 2022 highs. He adds, at this sector level, there is further tactical rotation opportunities out of banks and into the IT sector. This is a year-end portfolio rebalance trade of taking profits in the winners and buying some laggards. TCS and L&T Technology are presented as buy candidates, while IDFC First Bank and M&M Financial Services are presented as take profit candidates.
Okay, let's get you some money market views as well. So we've got some opinion coming in from Abhishek Goenka of IFA Global, who says that war between Israel and Palestine adds a new dimension of uncertainty in terms of crude prices. He says our current account, which is already reeling under slowing exports, could come under pressure even further. He goes on to add, in case that is accompanied by broad risk aversion, we could see outflows on the capital account front as well. In that case, the RBI, which has been intervening around 83.3 levels, so far may have to let the rupee adjust in order to conserve its reserves. However, he says if there is de-escalation, then we could see the rupee continue consolidating in the 82.4 to 83.7 to a dollar zone.
All right, and on the bonds, Ajay Magnolia of GM Financial says domestic bonds saw a spike of fears of higher bond supply after the RBI announced OMO sale to manage liquidity. He says rising oil and commodity prices amidst the current situation may impact sentiment, though a lower September CPI print may provide some relief later in the week. Hope for the day is softening US 10-year yields. He expects the 10-year benchmark bond yield to trade in a range of 7.33 to 7.4%.
Well, we have a lot of stock-specific action to track for you. We get to that in just a bit from now in our special Top 10 segment. For the time being, we run you through the list. We're looking at Maruti Suzuki, Phoenix Mills, GR Infra, Genius Power, Mazagon Dock. Their stocks will be reacting to positive news flow, where we're split down the middle. 5 stocks could be reacting to positive and 5 could be negative. Let's run you through those stocks. Concor, Dr. Reddys, Cipla, Sun Pharma, and Natco Pharma.
Okay, well, we've got Cameron Brand, Director of Research at EPFR Global, now joining in to take some questions. Cameron, good to have you with us here. Good morning, and thanks for your time as always. I'm looking at the bond markets overnight were closed, but as compared to Friday's close on the US 10-year, the implied open is almost 16 basis points lower. That is a very large move we are talking about when, if that stays all the way into open, US open today, bond market open today. What does that indicate to you, and have you seen sort of flows move in a very significant way?
Yes, well, that indicates to me, and it's something I've mentioned before, even though there's a great deal of broad market concern about the spike in U.S. yields, there's a lot of people over here, both institutional and retail, who are still making up what you might call lost ground from the previous decade in terms of getting U.S. debt on their books that provides a decent return. What we've seen in the fund flow space is a marked separation between funds dedicated to investment-grade sovereign debt at the expense of funds in riskier asset classes, such as high-yield bonds and emerging market bonds.
So what does this mean for flows into a market like India? There is, of course, this narrative that money will move out of India and into markets like China because of the valuation argument, right? Do you think that narrative holds even now? And what is the expectation as we move along?
Well, at the moment, what we're seeing is a continued broad interest in Asia. Though the intensity of flows into dedicated India funds isn't quite what it has been, it's still above average, and there's still very strong flows week in, week out to China, Taiwan, and then recently Korea equity funds. In fact, Thailand equity funds in the past week had a multi-year high in terms of inflows. And obviously, the closer we get to the end of the year, there'll be probably less attention on low valuations and more on making sure that your portfolio has a healthy allocation to markets that have performed very strongly. And in general, that is going to help India more than China.
All right, so that's good news then, Cameron. Good morning. Above average flows continue into India, though it's come off a little bit from the top, I'll say that's positive. But if you could break the equity flows up between, developed markets and emerging markets, what has been that kind of flow? And also if you compare it, say, with a couple of weeks ago.
Well, the pattern remains the same, which is that funds dedicated to most European markets are bleeding. And that in the equity space, it is both emerging and developed Asia. Japan equity funds are also doing well, along with the emerging markets groups that I just mentioned. A variety of factors for that, not sort of one size fits all. Certainly, I think the physical distance from the war in the Ukraine certainly isn't hurting, and now we have this flare-up in the Middle East. But there's generally a feeling that Asia offers at the moment the best sort of composite picture of relatively high growth, distance from trouble spots, still fairly good valuations in most of the regional markets.
What about flows into, the split between dedicated country funds and sort of the emerging market basket? How is that kind of holding up?
No, that's a good question. There's been a definite split there. Global emerging markets, the GEM equity funds, they've been getting fairly consistent and quite heavy outflows. Not spectacular, but hovering around the $1 billion to $2 billion mark week in, week out. And that obviously represents an outflow from India because India's allocation among those funds, until recently, grew pretty steadily. So, 8, 9, 10% of the average portfolio now is dedicated to India. So when they get outflows, that is not a net positive.
All right, Cameron, we'll leave it at that. Thanks a lot for joining in and giving us your take on what's happening in the global markets and markets like India. There is, of course, FI selling that has picked up in a market like India, but that's the argument between developed and emerging markets. Let's slip into a quick break. On the other side, plenty of stocks to talk about. Don't go anywhere. A list of top 10 stocks is lined up in just minutes from now. Stay tuned. Welcome back to Bazaar Morning Call. Well, this morning we have, a lot of stocks in focus. Our research team is standing by to give you that list. So let me kickstart with Maruti. That will be in focus this morning on the back of, presentation that they put out to make investors understand what their deal with SMG is. Now, Maruti has ended that contract manufacturing agreement with Suzuki, with SMG, Suzuki Motor Gujarat, and they shared an entire plan on what this means for shareholders. So just wanted to put some of that on board. They shared what their capex plans would look like over the next few years. They have a requirement of 4 million units production capacity by the end of 2031. This requires an additional capacity of 2 million in the next 7 to 8 years itself. And out of that, there is a 3 million unit target that they have to sell in the domestic market. They said they reiterated all their targets that they'd given out earlier, saying that the company will increase the number of models from 17 to about 27 to 28 models by FY31. Out of that, 6 models will be electric vehicles. They will kickstart electric vehicle production in FY25, and that will be from the Gujarat plant. By FY31, Maruti has a plan to get 15 to 20% of their overall revenue contribution from electric vehicles itself. So they put that entire plan in a presentation. Nomura put out a note where they said that this transaction may have some impact on the ROE of the company. The fact that they've ended this contract manufacturing agreement with SMG, but this is something that the street has already factored in when the announcement came earlier on. So they expect some negative impact on ROE. It will not have any impact on the EBIT of the business because SMG is a zero EBIT company. And they have already factored in a cash outgo of 423 rupees a share or a dilution of 4% has already been factored into the stock. So they maintain their neutral rating and a target price of 10,422. I'm going with green because, this news is known. It's just that additional details have been put out now. So going with green on the stock.
All right, green on that one. Then let's hop across to Ekta. She's joining us to tell us about a couple of pharma names that she's tracking. Morning, Ekta.
Morning. Well, definitely disappointing news which is coming for Dr. Reddys as well as the likes of Natco, Cipla, Sun, Zydus. I expect all of these stocks to probably see some red today. That is because Dr. Reddys, in an exchange notification last evening, has said that they have been named as a defendant in a complaint filed in a US court by Mayo Clinic as well as LifePoint Corporate Services, along with several other pharma companies. This is with regards to Revlimid generic, the cancer drug, which is worth around $6 billion in terms of market size. The claims by the defendants is that there was improperly retained competition as well as shared monopoly in the sale of the brand and generic Revlimid through respective settlements. So basically there was unfair competition which took place for such an important drug which is used to treat multiple cancers in the US. So that's the key contention point. Remember, Revlimid generic is an $8 billion drug. Now, Elara says that typically these litigations drag on for years, and we've seen them happen in many drugs over the past couple of years. Elara says that this is before it gets settled for amounts that are generally 20 to 40% of profits. Dr. Reddys has about 50% of its profits coming in from Revlimid generic. Sun, Cipla, Zydus Life have around 15 to 25% of their profits from Revlimid generic. So what we could probably see is all of these stocks in the red because there is uncertainty in terms of what the settlement amount could be. And also remember that there is litigation costs which they have to incur as well.
Okay, well, Ekta, thank you very much for that. So that's pharma in focus. Phoenix Mills is the next one, which we're going to focus on. Sonal is here with details. Sonal, good morning.
Good morning, Prashant. Well, the company will be in focus on the back of their Q2 update, which looked good across their segments. Let me start with the mall segment first, where the retail consumption was up 20% to come in at 2,637 crore rupees, and which converted into good collections as well, which grew 20% to come in at 638 crore rupees. In their residential segment, which is not that big, they have been able to do their sales and they've grown it very well as well. They talk about higher demand coming in. Their sales are up almost 200% in the residential segment at 292 crore rupees. Their hotels business, where the occupancies did see an increase in the first half itself, their average room rentals in their Mumbai hotel was up 32% at 15,767 rupees per room, and their Agra hotel, which is Courtyard by Marriott, their average room rentals went up by 13%, and this was supported by a rise in the occupancies as well. So going with green for Phoenix Mills today.
Okay, going with green out there. Thanks, Sonal, for that. Hop across to Mangalam. Mangalam, you're going with red for Concor?
That's correct, because it's more of the same for Container Corp. There has been weakness in their EXIM business, which is bulk of their volumes, and at the same time, their domestic business continues to grow, and that the company has been focusing on in terms of growth area as well. So in terms of their second quarter physical volumes update, the EXIM volumes have grown by about 3.5%, which is lower than the first quarter as well, whereas the domestic volumes have grown by 26%. But this again accounts for just 20-25% of their overall volumes, as a result of which their total volumes have grown at 7.6%. What have the first half volumes totally grown at? Close around 7.76%, and this compares with their annual guidance of 10 to 12%. So this means that now the onus is on the second half for the company's volumes to grow and achieve the guidance that they had given at the start of this year. Importantly, with the Israel-Palestine war, etc., will be important to see whether there will be further pressure on EXIM volumes as well.
All right, thanks a lot for that. So that's on Concor. Well, Surbhi is also joining in. She has a couple of more stocks that are in the news this morning. Surbhi, what are you looking at?
So I have three stocks on my radar. The first one is GR Infra. Now the Dibang Power Consortium, that is a JV between GR Infra and Patel Engineering, they have executed an agreement worth 3,637 crores with NHPC. Genus Power, they have won 2 orders worth 3,115 crores, and this is to install and commission 35 lakh smart prepaid meters. And lastly, Masgao Dock, they have signed a letter of intent with a European client. This is for construction of 6 firm and 4 optional multi-purpose hybrid power vessels.
Okay, thanks for that, Surbhi, and thanks to our entire team. Well, let's do a quick recap then of all the stocks that we just covered. Stocks with positive news flow, they include Maruti Suzuki, Phoenix Mills, GR Infra, Genus Power, as well as Masgao Dock. While we have 5 stocks that could be reacting to negative news flow: Concor, Dr. Reddys, Cipla, Sun Pharma, and Natco Pharma.
All right, let's take a short break on that note. On the other side of the break, Hemang Jani will be joining in for some fundamental stock analysis. Later, we'll connect with Azlin Ahmed of Argus Media to talk about the impact of the Israel-Palestine war on crude prices. Stay tuned.
Welcome back. Hope you're having a good morning. For starters, the Gift Nifty suggests we're going to be starting near the resistance zone of around 19,600 odds. So let's see how things move from there. That's on the equity markets. But for the time being, let's run you through the commodity action overnight. Manisha Gupta joins us to help us out with exactly that. Morning, Manisha.
Morning, and thank you for that, Nigel. Well, yes, we did see the crude oil prices gain up by 4% overnight, and we seem to be holding there. The markets are waiting for further developments. In last 24 hours, we haven't seen any impact on the crude oil production, and is the reason you are looking at flat prices at this point in time. Apart from crude oil, we've seen gold, copper, all of that also surged yesterday to nearly 1-week highs, while several other commodities, including natural gas, sugar, wheat, are also trading at multi-week and multi-year highs right now. But the street still wants to see on whether there is going to be a further escalation in geopolitical tensions. There are reports of Iran involved in planning attacks. So all of that, and we have seen various statements coming from countries as well. So at this point in time, it still is a knee-jerk reaction. This is still sentiment into the prices. We haven't seen on-ground impact on any of the commodities. Is the reason you've started this day on a more flattish note. Also, China did some buying yesterday after the return from a week-long holiday. Yesterday, the U.S. markets were shut because of Columbus Day. So that U.S. participation and movement might be seen during the evening today. The day is expected to be on a consolidation side.
All right, thanks, Manisha, for that. Azlin Ahmed, editor at Crude Oil India, is joining us, to give us more details on what she expects. She's the editor at Argus Media, Azlin, thanks a lot for joining in. I wanted to check with you on what your view is from here on, because there is, of course, this potential supply disruption that everyone is talking about as the conflict escalates further, right? What do you think the impact of that would be on crude oil prices?
Yeah, I mean, okay, right now, as you can see, the market went up yesterday, immediately after the event, right? And we've stabilized. I think like now the market is on a wait-and-see stance. The immediate concern, I think, is whether there would be any repercussions on Iran should the U.S. feels that Iran was involved, and take any measures like, for example, enforcing the sanctions on Iran, because we know that Iran production has been increasing, exports have risen. Should there be sort of like real enforcement on Iran, that could potentially either stop or reduce the crude oil exports from Iran. And that is coming at a time when the market supplies are actually pretty tight because of cuts by Saudi Arabia and a price cap on Russia. So I think at this point, the market is just watching to see if that happens. Now, further out is just to see what happens after this, whether it escalates or not. And I think that would be quite risky. That would be quite dangerous if the violence escalates or more countries get involved. But I think at this point, the market is just watching to see what happens next, and in particular, whether there's any repercussions on Iran, particularly from the US.
So this is the very near-term observation, right? That things could go either way, and it's kind of like a binary event because you don't know whether that de-escalation would happen or not. But in the slightly longer term, do you believe that oil demand is going up? I'm asking you because the OPEC also put out a report where they have raised their long-term demand outlook on oil. What is your longer-term forecast on both oil demand as well as crude oil prices?
Well, I think that at this point, it's to predict where the oil prices are going to go in the longer term would be very difficult, right? We really don't know what's going to happen next week, next month. What I can say is that I think in terms of demand, China's demand so far, I think this year, after the return of China from COVID, has been a little bit disappointing. So it's been a bit lower than a lot of people expect. And there are still concerns about the property sector in China that is having a dampening impact on diesel demand on China. Going forward, I mean, I think the market expects that, there would be some strengthening in demand in China, but you're still trying to figure out, potential inflation in US, recession in Europe. So I think that our expectations is that demand will increase, assuming that the market goes back to normal. We do think that supplies next year from OPEC could also increase because higher prices means more producers would want to produce more. And that could keep a lid on prices. But I'm assuming that everything goes back to normal within a very short time.
Okay, and that's based on sort of historical evidence, or what's Azleen? What's that coming off? I mean, we're all hoping it all sort of de-escalates quickly, but
yes. Well, I think that right now, I mean, I think the thing is that the assumption, I'm not sure. I honestly have no idea how things are going to develop. I think the assumption is that nobody possibly wants a war in the Middle East. But again, I really don't know what other countries are going to get involved, what US, So, but the thing is, if you just look at prices and you look at supply and demand, higher prices, as I said, if things do not escalate and it is just contained within, Israel, Palestine, and it doesn't go beyond that, I think the expectations is that there will be a cap on prices even into 2024 because supplies technically should increase.
Yeah. In 2021, Azleen, when that last, I think there was an 11-day conflict, was a pretty intense period. Oil prices rose 19% in that short 11, 12-day period. That was the last Gaza war.
Yes.
And then Egypt stepped in and brokered peace. So that was a very large move in a very short time span. I mean, are conditions very different as compared to then? I mean, some of the other underlying conditions for oil?
Well, I think that the one thing right now is that I think demand is not surging. I mean, if you look at overall demand, and I'm thinking more like China, it's not surging. We're not in a surging demand. Also, I think if you look at the demand supply, the reason why we are in a tight supply situation is because Saudi Arabia has voluntarily cut about 1 million barrels per day for the last couple of months. So assuming, if there is an actual shortage in supply right now, given the current fundamentals. What I'm saying is that Saudi Arabia could put back more crude into the market. So I'm really not ruling out anything. I think that the prices can go up, the prices can go down, because I think that at this point, it would be, I think it'd be very, very risky for anyone to say, we're going to go up to this amount or we're going to go steady. I think nobody can predict that. But if you just look at the demand supply, what I'm saying is that there is a little bit of buffer, because the current supply situation, the tightness in supply, is because of voluntary cuts by Saudi Arabia and because of what's happening, sanctions on Russia and the US saying that they want to enforce the price cap. So that actually has curbed the supplies that are coming into the market. So, you know what I mean? Yeah, but I would not be able to predict how much more prices could go up. I think it's anybody's guess at this point.
Okay. All right, Aslan, thanks so much for stopping by and filling us in with your views on the crude market. And we look forward to having a chat with you as this entire situation does evolve. For the time being, let's come back to our own markets. And we've got plenty of stocks to discuss. Hemang Jani joins us on the show. Hi, Hemang. Good morning. Always good speaking to you. Well, we've got a couple of quarterly updates that came out overnight. That's Phoenix Mills as well as Concor. Have you had a look at either of them? And what's your view on these stocks?
Yes, good morning, Nigel. I think Phoenix, the update was quite strong. I think we've seen almost about a 20% kind of a growth, in the consumption, and even the new properties, particularly the Ahmedabad Palladium, has started doing well. The hospitality portfolio anyway is doing pretty well, particularly St. Regis Mumbai and Courtyard Agra. So my sense is that the consumption, the discretionary, consumption across, the retail space, the hospitality, and even the commercial space is showing very good traction. So I think, the Phoenix Mill should do well. It's one of our preferred picks in the discretionary consumption space as well.
Okay. The other stock I wanted to ask you about was Maruti. Of course, the company has come out with an update on their ending their contract agreement with SMG, what this means for the company, etc. But now that that's out of the way, what's your view on the stock itself? They have a slew of new launches coming up. Begin FY25, they're going to start with EVs as well. At this price, is the risk-reward favorable?
Very much, Sonia. I think we've seen, the SUV portfolio doing pretty well for Maruti, and now they are the market leader when it comes to compact SUVs. Also, the festive season, though it's a little bit early, but I think the numbers, particularly for the SUV and the small passenger vehicles, are showing good traction. So I think with the certain events out of the way and the fact that the company has reiterated its overall production guidance this year, which means that Maruti will be doing reasonably well this year, and it will again be one of the top pick in the auto basket.
The one space which sold off very aggressively yesterday, Hemang, hi, good morning, was PSU Banks. The index itself was down 3%. What caused it? Was it a broader market thing? Was it yields being quite high as compared to pre-RBI levels? What was it? And what's the near-term forecast?
John, the BFSI space, the high beta space, so whenever you have some sort of news which can have the potential to either take up the oil price or the bond yields, which anyways are higher, that space, typically underperforms. Also, the 10-year bond yield post the RBI policy are up almost about 12 to 15 basis points. So I think there can be slightly, negative stance there from that perspective. But quarterly numbers, our sense is that will be reasonably good across the PSU and the private bank space. 20% kind of a growth in the PSU banking universe, and about 22% in the private banking space, without material pressure on the NIMs, which were the highlight, like the previous quarter. So that is definitely boding well for the PSU banks.
Okay, let's do one thing. Let's take a short break. Let me tell you what's lined up in the next half hour of the show. Coming up, we have Anuj joining in for a quick trade setup. Post that, we'll bring you the top stock picks for the day from our technical and F&O experts. And before the market opens in CNBC TV18 Stock Board, we'll highlight the top stocks in the news to focus on for the day.
ये है इंडिया के
Okay, welcome back. We're about 15 minutes away from the pre-open session, and things are looking much better. Asian markets are higher overnight. US equity indices were up as well. Bond markets were shut, but the big one, I think, to watch out for this morning is the very sharp drop in US 10-year yields, which I think are indicating almost a 16 basis point fall from last Friday's close. Remember, bond markets last night were not trading, but the implied open on your screen, we shut at 4.79 on Friday. We're going to open at about 4.63. That's a very, very steep drop that we're looking at. Anuj is here on the big wall with how he's looking at the trade setup. Anuj, morning.
Morning, Prashant. And you know what? I'll repeat what I said yesterday as well, that war and geopolitics normally provides you the best entry opportunity. And that's always been the case. It's proven with the anecdotal evidence. Of course, traders must still respect the screen and trade with stop loss. But the level I'm watching out for today is 19,675. If you cross it on the upside for any reason, then you can expect a short covering bounce. Also, Brent hasn't rallied much after yesterday's big move, so that's a bit of a positive for us. The US market, there was a sharp recovery after that statement from the Fed official who's normally very hawkish, which is indicating that there will be a pause on 1st November. And I think that's something which led to dollar index and US bond yields both cooling off and ending at days low, and equities closing at days high. So the Indian markets are in for a gap up. And what that bond yield collapse would mean is that IT could have another field day today. That could lead the market once again. On the Nifty, the support level that I'm watching is 19,480, which was yesterday's low. And after that, straight away, you go to 19,255, which is last series low. But my sense is 19,480 should hold out. On the upside, first resistance is 19,637, which is the following 20-day exponential moving average. That's been a bit of a resistance. But that 19,675 is big resistance. That's a series high. If you cross that, perhaps big short covering. On the Bank Nifty, it's been an index which has been one shade weaker so far. So if the short covering happens, maybe the Bank Nifty can lead it also, who knows. But it's been the weaker index. The first support here is 43,796 to 43,830, the recent low or the low of the last two series. And the bigger support then comes in at 43,150, the 200-day simple moving average. On the upside, the resistance is 44,113 to 44,145, yesterday's high and options based. And the bigger resistance is 44,432 to 44,555, which is a 10 and 20-day exponential moving average. And before I hand it back to you, I just want to wish everyone a happy World Mental Health Day. We at CNBC Awaaz are celebrating it. It's important to talk about mental health and not consider it as taboo. It's something that you should discuss because that's important for you, both in terms of your wealth and in terms of your health.
Oh, absolutely. And, we put so much focus on physical health always. It's about time we bring the focus back on mental health. There's no shame in prioritizing your mental health, taking short breaks, and of course, everyone is worthy of happiness and peace of mind, right? So focus on your mental health as much as you focus on your physical health. Thanks so much, Anuj, for bringing that important topic on board. But Mitesh Thakkar joins in now to tell us how to look at the markets this morning. Mitesh, good morning. It's been all over the place, so to speak, but the good part is that the Nifty has held on to that 19,500 mark. Purely for today, what is the approach?
I think, Friday when we left the market, it was a strong market. And then we had this international event which kind of disturbed the base. And we had a gap down. So while the markets are not falling, and which is a very positive sign, there could be some base building going on. The process itself is a choppy one. So I think till that time, you might be slightly cautious and still want to buy near the support areas. My range for the Nifty is about 19,725 on the upside to about 19,450 on the downside, and in the worst case scenario, 19,230. So looking at that kind of a scenario, I think, on the index, I think we're still in that process of finding a good consolidation and then possibly breaking out of it on the upside and then restarting some kind of an uptrend. Till that happens, you will see this bouts of volatility remain. The level of 19,725, once that is crossed, then I think we can look at possibly a much smoother and a much stronger approach. So till that happens, use declines to buy into it and keep tight stop losses because it will be choppy market.
Okay, it'll be a choppy market. Gentlemen, good morning. Sudarshan, how are you looking at things this morning?
Well, markets are not very cheerful. So it's a little bit of a question mark. We have this mild rally after yesterday's decline, whether this is a small relief rally, whether it will fizzle out or not. I mean, there is no clarity on the charts, there is no clarity on the strategies or the systems that we use. So my view would be that because of the fact that we are still in an uptrend, traders should try to see if they can keep a 75-point stop loss in the Nifty. Maybe it'll work out, but that's a big question mark. But that's the only trade. Try to go long with a stop of 75 points and keep it intraday. Don't carry it. Again, the Bank Nifty is an avoid.
Okay. All right. Mitesh, let's come across to you. You've been maintaining that number 19,725 on the Nifty, for the last few sessions. So let's see whether or not we get there. But individual stocks, what are the trades you have?
Yeah. So with the day's theme, I have more of buy calls. Bajaj Finserv, the structure is turning very positive in the last few days. Recommend buying here with a stop below 1600 for a first target of 1670. Then there's MGL, which did very well last week. There was a big breakout candle. And since then, we've seen a few days of sideways consolidation. I think this could pick up steam. Buy here with a stop at 1094. Look for a first target of 1150. And Metropolis has had some kind of a reversal. That's the buy as well. Stop loss of 1480 is what I recommend and a target of 1545. One sell call, which is ACC. Some kind of breakdown has happened yesterday. And even if you open gap up, I think that can be used to sell into this stock. So sell around 1975, keep a stop at 1998, look for targets of 1925.
Okay, and Sudarshan, what about you?
Well, I have a mix. Auto pharma is a buying opportunity, and pharma companies do their own thing. Sometimes they are completely disconnected with the primary index. That seems to be happening. Buy with a stop under 887. Deepak Nitrates is an intraday short. The stock is in a sustained downtrend. Intraday short with a stop above 2095. PVR is again just beginning a correction. Now that correction appears to be going to be a deep correction. That's the sign. So it's an intraday short with a stop above 1698. And finally, TVS Motors is a buy. It's in a small trading range after a big rally. Usually these ranges break on the upside. So you can buy it with a stop under 1495.
Okay, gentlemen, good speaking with both of you, and we'll come back to you for more in a bit from now. We have Manoj Muralidharan, Vice President Derivatives at Religate Broking, also joining in. Manoj, good morning. Good to have you with us here. Again, how are, from the F&O side, things set up? Yesterday was a big give back day, but this morning it may be better.
Well, good morning. Ideally, for the October series, the equation that we have, at least from the FIR desk, they are cautiously hedged. Almost 74% of their index positioning is on the short side from September to October. But the good thing is, usually, this picks up to be around 80 to 85%. But that is not a major criteria, because FIRs, the weightage, if you see in the market from 2017, has dropped from a good 60% to almost 40-48%. Now, the interesting part is, generally, because of this weekly expiry that is coming, we see a lot of option selling happening. And even if you see, the VIX has meaningfully not gone above the 13%. Beat the correction of a good 800 odd points also in the Nifty. So we believe that 19,500 put selling and 19,800 call selling. That's the equation that is going on. So Nifty would be range bound, because even if you see the major move which came, let's say from 19,300 base that we made 4 days before to almost is 19,800 or 700 was because of short covering, and the long built up weighted average price is closer to 19,500. So Prashant, the range bound session with the option selling is a strategy that can be done, because usually Tuesday the market gets into a range bound session. And I guess post 12, when the result season starts kicking in, the market might take that as a trigger, and then we might resume the upside. So as of now, it's a range bound session. Stock specific, I believe that Coal India and NTPC, this would be the two stocks which have been seeing good delivery buying as well as derivative build up into the September as well. Got rolled into the October series. So Coal India at 285 becomes a good buy. We expect a target close to 296 on that. The stop loss should be 278 on that. And NTPC as well from the power, we believe 233 to 235. That's a good level to go long. The stop loss should be 227, a target of close to 242 on the stock.
All right, thanks a lot for that. Let's slip into a quick break. On the other side, we'll come back with the pre-opening rates. We'll also have Harshvardhan Dole of IIFL to put focus on the power sector. Stay tuned.
powered by Century.
Welcome back to Bazaar Morning Call. Well, in about 10 minutes from now, you have the market opening coming through, the pre-opening rates that is, and 70 points higher on the gift nifty as we speak. Hemang Jani is still with us, so let's get talking to him. Hemang, the big event upon us is the IT earnings, right? So you have TCS tomorrow, then through the course of the next couple of days, Infosys, HCL Tech. What's your pick of the pack now? If you wanted to buy a stock ahead of earnings, which one would it be?
Going into the earnings season with very low expectations, and the stocks also have underperformed big time. So despite the fact that the quarter per se is going to be slightly muted, there can be some element of surprise in terms of earnings, particularly from TCS and some of the mid-cap IT names. Also, the buyback is something that the market would be watching out for. Coming to the picks that we would like to recommend at this point, in the large IT space, we would go with TCS. And as far as mid-cap IT is concerned, I think Cyient and LTTS, these are the two names that we like in the mid-cap IT companies.
Well, Hemang, what about the domestic themes? A couple of cement companies will start reporting in the next 7 days or so. I think on Friday, we have Dalmia that comes out with their numbers. What's your view out there? Off late, I've been hearing that, Nigel, watch it, in the next 6-7 months, we're going to see a lot of consolidation. And it seems there are a lot of assets that could be consolidating in there. Your view on it, would you go with the large cap or the mid cap names?
Well, combination of some large caps and mid caps would make sense. I think from a re-rating or upside potential point of view, some of the mid cap companies would make more sense because there is going to be some excitement around the M&A plays which is happening. So I think JK Lakshmi would surely be one of the companies that we like. Dalmia is something that we've been liking. And within the small cap company, I think NCL is something where we think that the valuation comfort is very high, hardly about $60 per ton kind of valuation with very good earning visibility. So I think cement as a pack should do well in the current scenario.
Okay. All right. That's on the cement space, right? Any other stocks, Hemang, that you expect could perhaps be the big movers in this earnings season? We have HDFC Bank's numbers that are coming out in less than 10 days from now, and that will be the first time post the merger. So what is your thought on that? And any other large caps that you'd keep an eye out on ahead of earnings?
So clearly, HDFC Bank has been a laggard, particularly last 2-3 weeks because of the that provisioning news that came out. But I think at current price point, it looks quite reasonable. We are looking at about 16 to 18% kind of earnings growth this quarter, and a very reasonable valuations. Also, NBFC as a space should do well. So Poonawalla FinCorp, Mahindra Finance, these are the two names that we like within the NBFCs. Also, some of the real estate companies, Godrej Property in particular is something that we've been liking, given the kind of traction that we are seeing on the new project announcements and the sales growth both.
Okay, no, point taken. Just a quick word, Hemang. The big story, unarguably, I think this morning is the very sharp drop, from a global perspective, is the very sharp drop in US bond yields. They were not trading last night, but from Friday's close, as we were making the point earlier, yields are seen opening some 16 basis points lower. The question, though, is it positive or negative? Yields, it's because, what is the reason for this to go down? Is it a risk-off signal because of, the war, etc., uncertainty, etc., ahead? And this, by the way, would be consistent with the 20 basis point fall that we've seen in US yields in the last two episodes when the conflict came through. But back then, US equities also sold off 5%. So I'm just kind of, you can look at this and say, well, sharp drop in yields, great for tech stocks, growth stocks. But is it as simple? Is it as straightforward? Your sense?
Looking at certain global macro data points and relating it with market movement is going to be a bit tricky. Just to give you an anecdote, on Friday they came out with job report, and the job data was far better than market expectations. So the logical expectation was that the market would react negatively because there would be higher probability of rate hike. but the market chose to react other way. So similarly, large part of this higher bond yield is now pretty much known, and people are waiting out for some additional triggers, be it in terms of inflation or some, indication from Fed as to when these rates will peak out. So I think the market will have its own kind of way to react to it. I think the earnings season in US and India will play a far important role rather than some of the macro data points which are be far more volatile in the nature of the market that we are living in.
Okay, all right. I wanted your thoughts also on, I mean, we were talking about, all right, let me just get to the pre-opening rates actually. The pre-opening rates are kicking in, so let me just try and get some rates in. Okay, in just a minute from now, we'll get those rates on board. But any other thoughts, on a couple of these names in the banking space? What is your top pick now that you're looking at in banking, both from the large and the mid caps? Because this time, as far as business updates are concerned, there was some strong traction that came through, even from the PSU banks.
Yeah, so PSU banks actually have underperformed in the past few trading sessions, maybe because of the bond yields going up. But I think from a quarterly results point of view, BOB, Canara Bank, these two names should deliver reasonably good, about 18 to 20% kind of a growth. SBI also, I think after last quarter, the NIMs are not looking that great. I think this quarter, there should be some stability in the NIMs, and we are seeing a good amount of, interest coming back into SBI. So I think PSU banking space, purely from a results perspective, is looking, set for maybe 8-10% kind of an uptick.
Okay, all right. Hemang, stay with us. We will come back to you with more in just a bit from now. By the way, the pre-open is there on your screens now. Now, this is not going to be the opening that we get. I don't think so, at least, with Asia up, and some of the other factors. So yeah, it's moderating and things are starting to settle down a little bit. 100 points lower on the sense, but let's just give it, I think, a minute more before we go any further. Well, IIFL in a recent note indicated that power demand is strong on the back of a recovery in economic activity and growing, demand bodes well for players across the value chain. Let's discuss this with Harshvardhan Dole, who is, of course, the veteran analyst with IIFL, who tracks the space closely. And of course, Harsh looks at oil as well, so we'll pose some questions from that sector as well. But let's start with power. Harsh, what's the view? One clear view which has emerged is that, well, power demand is strong, so thermal sort of capacities, etc., need to be built up. But it's like a 4-5 year finite story. And then after 2030, terminal value goes to zero. Is that the way you look at things? And is there any way to sort of take advantage if you believe that to be true? Go on.
Hi, Prashant. Thanks. So in my opinion, the structure of power sector has changed materially over the last 10 to 15 years. Those who have survived are thinking about thermal plus green energy as essentially way to scale up their respective businesses. So consider NTPC. While NTPC is adding, almost 20,000 megawatt of thermal power plant, it has plans to add 60,000 megawatt of green energy. And that's a material number considering their existing portfolio of assets. So when you talk about 2030, when perhaps a large tail of the thermal power plants will be fully commissioned, they will be ready with an arsenal which is as big as any other player in the country to grow the respective green energy business. And to that extent, when we do the DCF for the players who are actually surviving, per se, the DCF, when we do, the terminal value does exist for a lot of these players. There will be smaller and marginal players whose survival will be an issue. And perhaps DCS, doing a DCS exercise beyond next 4 years may not be fruitful. But for the large players like NTPC, Power Grid, NHPC, Tata Power, CESC, Torrent, I think there is a growth even beyond 2030, simply because they have distribution assets and of course they have ambitions which are other than thermal.
Hi, Harshvardhan. Good morning. Nigel on this side. Yesterday we had the management of Inox Green actually who joined us. but that has obviously implications for the group on the whole. And they are sounding very, very confident, in terms of the commentary, in terms of the capacity and the business they're doing. And they also said that EBITDA will grow at a faster pace than what we're going to see in terms of capacity as well as top-line growth. What's your view on them? Because these renewable-related stocks, they've already run a goodish bit. Suzlon, Inox Wind. Your view on them?
See, I wouldn't want to comment on the valuations because the valuations will be function of too many things, liquidity, essentially the hope, etc. But after meeting both Suzlon as well as Inox, what we realized is essentially the industry structure is bottoming out. There is a long runway ahead of all these players. And if they are able to clean up their respective balance sheets, perhaps maybe the first round of cleanup is over, maybe a couple of more is pending. If they are able to do that and follow up with massive execution, I think these stocks can materially re-rate from here on. I mean, if you were to do a simple back-of-the-envelope calculation, in peak days, wind industry did about anywhere between 7 and 8 gigawatt. After what the financial restructuring these both players have done, the respective break-even levels are well below 1,000 megawatts. And even if they are able to get 25 to 30% market share, assuming that industry does about 8,000 megawatt, there is a huge operating leverage. But as I said, the execution challenges need not be undermined. There are execution challenges. Perhaps second leg of balance sheet restructuring or cleanup is likely to pan out in next 12 to 18 months. Subsequent to which I see the sector far more saner and growing what we have seen in sync with solar.
Right. Harsh, hi, good morning. This is Sonia here. Just one quick question on what your expectations are from the CERC regulations that are upcoming. What changes do you see coming and what would this mean for any of the listed stocks?
See, CERC is expected to come out with draft regulations, perhaps towards October end or November end. And that should lay a foundation stone of what the tariff structure is likely to be beyond FY24 for the subsequent 5 years. However, when we talk to the industry, do some channel checks, I think the regulatory system is likely to take far more pragmatic view and be slightly more lenient towards the existing structure rather than taking any adverse, rather tweaking the regulations adversely, which might have repercussions across the chain. As of now, the demand is strong and looks like there are only a handful of players who are equipped to meet this incremental demand. So why disturb the Apple cart?
No, but in terms of stocks, okay, let's try and sort of put all of this together. Tell us what are your top picks and quickly what is the trigger behind it?
So I think after the massive run-up in the stocks, I should reckon that these stocks are not trading at distressed valuations. I would say that relative to FY24, the valuations are fair. Let's see how the regulatory framework evolves. And once that is clear, I would be more constructive on NTPC, Power Grid, Torrent Power, and maybe players like CESC. But we are positive on the entire value chain and would like to play the whole story through the utilities.
All right. What about the smart meters? They had a big run. And even yesterday, we saw Genius Power winning a big order of more than 3,000 crores. What's your view on the stocks? I don't know whether you'll have official coverage. But clearly, smart meters is going to be a theme, not just for this year, but for the next few years, going by the central government's vision.
Absolutely. In fact, when we had put out that note on smart metering, what we had put forth is this is a great beginning, and it should be supplemented by what they call as prepaid meters. And the smart meter theme is fairly strong. You have seen that from the order book that most of these players are getting. And if the execution is good, I think money can be made by the meter manufacturers as well as somebody who's managing the meters. And of course, the consumers will get 24/7 power at reliable tariff. So it's win-win for all. And in my opinion, what now holds the key is all the distribution companies coming together, realizing the benefits of smart metering and basically giving large bulk orders as what we have seen in past few months. So we are quite upbeat on that segment as well.
25 crore meters, right? I mean, that's the big number, which I think was put out. But that's over the next few years. Harsh, but have you looked at what stocks are pricing in, Genius, etc. recently, or no? Because they've run up quite a bit.
Unfortunately, we don't have a formal coverage on the name.
Correct. Correct. I mean, no, absolutely. But I hope you take a look at it and tell our viewers, because there's been so much interest around it. By the way, I think utilities have started sending out notice. I got an email from Best, which is the electricity provider in where I live, saying that we're going to be starting to transition into smart meters. So I think they're rolling it out as we speak over the next couple of months. Harsh, from the power space, let's talk about the oil and gas space. Will people make money buying, upstream companies here because of the sharp rise in oil? Oil prices are up some 30% since the middle of the year. That is one. And your view on oil marketing as well. Go on.
So I think looks like the valuations across the chain on the PSU front are ridiculously cheap. ONGC, after the outperformance, is still trading at 4 to 5 PE multiple. And this is a company that we are talking about almost 40,000 crores in terms of profits. So profits and cash flows is surely not an issue. I think what remains an overhang for the stocks across the chain is the fear that the government might actually come and take most of these gains from players across the value chain. And that includes upstream, midstream, as well as downstream. And that is reflected in their valuations. Let's look at OMCs. IOCL, which is one of the largest refiners and marketing companies in India, is trading at 0.7 time to a book. And at a time when first quarter has been great and second quarter is likely to be equally strong. So I think there is no answer to the fear that the investors have in their mind. Perhaps one has to wait out till the time this terminal phase in terms of volatility in the oil or some of the elections are over.
Harsh, we'll let you go on that note. Thank you for explaining the entire power sector to us. Well, for now, the pre-opening rates have settled higher, similar to what the GIFT Nifty was indicating, up about 53 odd points. Adani Ports, Titan, Tata Steel, Hindalco, Hero MotoCorp are a couple of stocks in the green. Mitesh and Sudarshan are back with us, so let's get some 9-10 calls going. Sudarshan, what's the big call at 9-10 today?
Well, Oro Pharma is a buy with a stop under 887.
And Mitesh, what about you?
I will go with the buy on Bajaj Finserv. Stop below 1600, targets of 1670 here.
Okay, that's a buy on Bajaj Finserv and Oro Pharma from Sudarshan and Mitesh. But let's also talk about some more stocks. Escorts is in focus. DAM Capital actually raised their target price on Escorts quite substantially. They raised it to 5,100 from 3,150 earlier, and they value it at 30 times forward earnings, FY26 earnings rather. So 5,100 is a big upside to where the current market price is. So that could be one of the stocks in focus. The clear rationale is they see a lot of synergies because of the merger between Escorts and Kubota. The market share expansion is what's happening because of synergies and relative strength of each brands in their respective markets. They also talk about how volume growth and filling of the product gaps is something that Kubota and Escorts are working on together. And that is coming through because of operational efficiency and localization. And exports have also picked up on account of new products and capitalizing on Kubota's global network. So they expect a revenue growth of 17%, EBITDA growth of 37%, and profit growth of 41% compounded over the next 3 years. And hence, they're quite bullish on Escorts Kubota. So, that's a stock that they're focusing on.
All right. Well, the other one that took a knock yesterday was Adani Ports, but various brokerages have written on it. Surbhi joins us to give us some details on them. Surbhi?
Thanks so much for that. So Motilal Oswal has initiated coverage on Adani Ports with a buy rating and a target price of 1,010. They say that the company is well poised to post a 12% volume compounded growth over the next 2 years. The company has evolved from operating just 2 ports in FY11 to now 14 ports across the country. They have improved reach, strategic port locations and a comprehensive range of integrated services offerings, which has led to a volume growth of over 4 times from FY11. Now the cash flow generation should remain strong, and that will help to keep the debt in check despite the acquisitions. CLSA has also written on Adani Ports. They have a buy call with a target price of 878. They've said that the Israel conflict has caused a 5% fall in the stock for a 1.3% value for Haifa port. Now, Haifa has accounted for 3% volumes in the first half of the fiscal. The company expects a payback period of 4 to 6 years under the worst case scenario, and the war fears presents an even better buying opportunity, and that is what CLSA says, the better buying opportunity for the strategic assets with long duration concessions.
Right, well, we have a minute before we get into the market opening. Just a couple of more stocks that I want to mention. Adani Ports, of course, as my colleague was mentioning, there is that, CLSA report on Adani Ports. Just pull up the stock. The stock is at 800 right now. CLSA has a target price of 878 on Adani Ports. So they say that war fears present a better buying opportunity. I think that seems to be the case across the board where, every dip that we're seeing in the market is used as a buying opportunity because of the geopolitical tensions, and that, it's something that's played out earlier on as well. Mazgaon Dock, by the way, has signed an LOI with a European client, and that's one of the big movers in the broader market, so don't lose sight of that. Almost 7% higher on Mazgaon Dock. Dilip Buildcon has signed an order worth almost 400 crores, so that stock is up about 3% in pre-opening. Just take a look at that one. About volumes are picking up on Dilip Buildcon. And Genus Power is the other one. 3,100 crores of orders is what the company has won. So Genus Power is up almost about 5%. So plenty of these stocks actually in pre-opening are kicking it out of the park. And just about 13 seconds left. Looks like the market opening is going to come in smooth this morning, and we're going to have the first tick in the green. So let's just wait by for the opening rate. Heavyweights like Titan continue to bat for the bulls. There we have it, 65 points in the green for the Nifty, holding on to 19,580, turning out to be a good start. The first tick on the index is a positive one, 72 points higher now. The mid-cap index is up 220 points, and the advanced decline ratio is well in favor of the advances at 1,860. The Bank Nifty is also up about 200 odd points. What's leading from the front this morning? Adani Ports on the back of that CLSA report, as we were mentioning. ONGC has been moving with some strength because of the move in crude. Bajaj Finance, Hero MotoCorp, M&M, Tata Motors, all the auto stocks are up and about this morning. Bajaj Finserv, Adani Enterprises, Hindalco, a couple of other stocks in the green. There are barely any stocks in the red, actually. Dr. Reddys, Britannia, TCS, just 3 stocks that are marginally in the red. That too just about in flat terrain. Otherwise, it's a good opening for the market. The advanced decline ratio is now well in favor of the advances, and the Nifty is powering through to that 19,600 mark. Better opening for the mid-cap index.
Well, absolutely, Sonia, and plenty of stocks are moving around. Mazgaon Dock, they've signed an LOI with a European client for multi-purpose hybrid power vessels. That stock is flying away. Genus Power, they won that 3,115 crore smart prepaid meters. So that stock as well has bounced up close to around 5%. Remember, it corrected nearly around 10% from the recent peak. Now it's pulling back. GR Infra, that Dimang Power JV executed an agreement worth around 3,600 crores with NHPC. So that stock as well is up close to around 2%. SEPC, well, that's another stock that's coming on my radar. That's moving up. That for the second day running on rather large volumes. Just thought we'll highlight that. Dilip Buildcon on the back of that order win. So that stock as well continues to move higher as we speak. And a few names then, that are doing well from the frontline stocks. Escorts Kubota, that Sonia just mentioned, 3.5% higher. Union Bank is bouncing back today. Oil India continues to do well, building on yesterday's gains. And NMDC as well as higher with a gain of around 1.5%. Lloyds Metals, I haven't had a look at that, but you had a Queris note that had initiated coverage. They've stated various points that they believe that the stock is well placed from here on with regard to pricing as well as production. So Lloyds Metals should come up for you. The target price that Queris has given is around 600 rupees. That was 9% away from yesterday's close price. So let's get that up as well for our viewers.
Well, it's a good start, isn't it? By the way, as we were talking about it in the morning, we opened exactly into that 19,605 level, which is the nothing but the 40-day exponential moving average, which is the resistance. I mean, on the way down, actually on the way up, that is acted as a fair sort of nice support for a long time before it broke. As we try to come up again, I think we'll have to see if that is taken out with ease. But you're opening, we open about just 10-15 points short of that level. And I think the day's high is exactly that. So around 19,600 is where the Nifty is at. Now, a few other names. You've got I think Mazgaon, Nigel mentioned Cochin Shipyard as well, 3.5 higher. Escorts is coming up. Shipping Corporation is another one, 5.5% on Shipping Corporation, 152, large volumes. Garden Reach, of course, we put out. So these shipbuilders are all doing well. There is Genus Power, which we mentioned, 5%, limit up. So nothing very much else if you want to just find stuff with decent-sized volumes, maybe more into the mix a little later as we kind of continue to trade. But for now, on the upside, there's not very much else which is coming through. On the downside, maybe Suzlon, perhaps we can highlight. It's down 3.5%. So almost got to 30-ish kind of levels, but it's now back on just under 27. And look at Triveni Turbines, which is down about 3% or so as well. And that is down a little bit. So yeah, those are the two names I can spot, which have got volumes and which are down 3.5%.
Just one more stock I want to point out, which a viewer actually has brought to my notice. That is Aventel. It's a small company that in the last few years has gone up big time. They came out with their numbers. And in fact, it looks very, very good. So just had a brief look out there. They're doing only 54 crores, but Aventel, it's a BSC listed company, 2,500 crores market capitalization. We're talking about it because it's actually at upper circuit and volumes are very, very high. So the numbers for the last quarter look very, very good. AVANTAL. I think we should get that up. Margins are the highest that I've seen in very, very long time. And in fact, just looking at it, a few years ago, they were doing 50 crores of revenue in a year. Now, in a quarter, they're doing it. They're part of that ships, submarines, etc. And it was, it's being built by this entrepreneur. His name is Mr. Vidyasagar. He's an IITian. And I recall 5 years ago, I asked him, I said, sir, but you're selling in the open market. He said, this is my only business. And I don't think it's anything wrong. So I said, from the share market perspective, they don't like it at all.
They've got it up.
Yeah, so that's the one they were talking about. And the only reason we're highlighting it is because it's up close to 20%. Came out with its set of numbers. The market capitalization moved from around 200 crores to 2,500 crores in the last 5 years or so. In fact, I had forgotten that we had covered this as well a long time ago. But, have covered many, many stocks and just educated the viewers about certain stocks in the last few years. So this is one of them. Just thought we'll highlight
So it's up from 2020, July of 2021. It was 27 rupees. So yeah, it's basically in 2 years, it's up 10 times. So it's incredible. Absolutely.
Yeah, but there's no institution holding out here. Yeah. So, you need to put everything on board, though the operating cash flows for the first half of the year have improved.
All right. Well, so that's an interesting name, which we don't talk about. Actually, we've not talked about at all.
Ever
in the past. I think, 88 points higher is what we have on the Nifty, and things are coming together, nicely. So far, so good. Maybe we can pull up Zomato as well. Zomato is up about 3%, and we'll be seeing some delivery partners of Swiggy, at least here in Mumbai, on strike, etc. We've heard reports and such. But Zomato is up about 3%. That's a direct competitor. What else? Kalyan Jewellers, perhaps it was not there in the mix. We didn't mention it. 5.5% once again on Kalyan Jewellers. It's at about 266. That's also a doubler this year. We've got what else? I think Zaggle is another one, which is a recent listing, 3%. Zaggle has done well over the last few trading sessions or so. So more in a bit from now. Ashwini Agarwal is founder and partner at Demeter Advisors. He's joining us with his thoughts and perspective. Ashwini, good to have you with us here on the program. Thanks as always. Let's just start with banks and financials, Ashwini. After the last RBI policy, which was in a way as expected, but in a way unexpected as well, because the RBI said they're going to, do large-scale sale of government paper. Of course, timelines, etc., are not disclosed as of yet. That led to bond yields jumping higher quite a bit. What's the outlook for banks, both PSU and private, from here?
So, Prashant, what we are seeing on interest rates is, quite worrying from a global perspective. I mean, we've seen what's happened to U.S. government bond yields. And in the light of where U.S. 10-year government bond yields are trading, Indian government bond yields of a similar tenure are on the lower side. To my mind, there should be a 3 percentage point difference between the two, which is slightly narrower at this point. So my sense is that the yield increase at the long end of the bond curve is not just an Indian phenomena, it's a global phenomena supported by the fact that inflation continues to run higher than what most central banks would like to see it at. what does it mean for the banks? I think, my sense is that if you just look at the loans growth data that's been posted by the RBI, 17-18%, deposit growth of 11-12%, a shift away from CASA and higher bond yields. You put all of this together, and my sense is that while spreads will compress a little, there is enough operating leverage that you get from a 18% loan growth that you might be able to maintain your pre-provision operating profit rate for most of the banks. That's the sense I have. Below that line, you're continuing to see very benign credit costs. So I think from an earnings perspective, there is no need to worry for the banks just yet. However, having said that, if you want to look out 18 months from now, I think the rising unsecured loans is something that can create a problem if the economy were to slow down significantly. And the reason I say that is that while economic growth domestically is being driven by government capex, the export outlook continues to be fairly subdued. And we don't know what happens to the energy prices given the crisis that we are seeing in the Middle East at this present point. So, my hope would be that no new stress emerges over the next 18 months or so. But for the now, I would say that there is no significant earnings pressure.
Okay, by the way, there are a lot of stocks that are in focus this morning. Kalyan Jewellers, by the way, has hit a record high. So just keep an eye out on that stock, 6.5% higher now. And this year, Kalyan Jewellers has more than doubled. There's also big buying that you're seeing in real estate stocks. All of them are up about 1 to 3% Keystone Realtors reported their numbers as well. All of them, even the smaller guys like, say, an Ajmera Realty, Mahindra Life Spaces, the bigger guys like Soba, Prestige are all in the green right now. Godrej Properties, DLF, all up about 1 to 2%. Ashwini, good morning and thanks for joining in. Since we're talking about real estate, I wanted your thoughts there because, there is some hyperactivity happening in this space now in terms of, new projects coming on board, the sales that are happening across metros, right? Not just in Mumbai and Bengaluru, but even in places like Hyderabad. From an investor standpoint, is this a start of a multi-year upcycle and would you advise buying into real estate stocks?
Morning, Sonia. The way I think about it is that real estate and stock markets are joint at the hip. And every stock market rally with a lag leads to a real estate demand pickup. Add to that the fact that real estate prices went nowhere for almost a decade between 2010 and 2021. And that brought in the affordability of real estate within the grasp of a lot of people that had probably stayed out of the market. In addition to that, you've had a huge amount of wealth creation via the stock market, via ESOPs, via startups. And that's all starting to feed into the real estate economy. You also spoke about Kalyan Jewellers, something I don't own. Yeah. But, the connection I'm trying to make here is that we are also seeing a, continuation of the K-shaped recovery that we used to speak about during the COVID and in the immediate aftermath of the COVID. And so the rich or the well-to-do have a very solid potential to consume. You are seeing that in jewelry. You are seeing that in the Titan numbers that were reported for the month of September, quarter of September. And again, I have no position there. You're seeing that in real estate sales. You're seeing that in luxury cars. But at the same time, the not so well-off India, and when you look at consumer staples, you look at demand coming from rural areas, that's not very exciting. And I think, and this is a trend which is similar to what we are seeing pretty much everywhere in the world. It's not a great commentary because I would like the wealth effect to be more broad-based and to hope to see the trickle-down effect happen over a period of time. But it is what it is. From an investing perspective, I've always found it very tough to invest in real estate companies. There are event risks that I'm unable to forecast. So I like to play real estate, if at all, via proxies, whether it's plywood or tiles or fittings or, possibly construction materials in wood or cement or whatever have you. Directly buying real estate companies is always fraught with some amount of project-related risk, which I like to personally steer away from.
All right. Hi, Ashwini. Good morning. The last time we chatted, everything was looking up, but you told us that we're lacking triggers to go to 21,500, 21,000 odd. And it appears there are plenty of headwinds that have turned up since then. Whether you're talking about the Fed speak, the move in crude, the dollar index, and now, unfortunately, this Israel war that's breaking out. Do you think the ingredients are in place for us to see a sharper correction from these levels? Because give and take everything, we're still only 3% away from the recent highs.
Nigel, what you said is absolutely right. I think, there are all the elements in place for a sharper correction to happen, but whether it will happen or not totally depends upon the domestic investor sentiment. If you think about it, the flows into the market are quite robust. Mutual fund inflows are reasonably robust. Direct inflows are quite robust. And till the domestic investors are comfortable, till there is no imminent real risk to the domestic investor appetite, I think, a very sharp sell-off is out of the question. Now, can we get a 5%, 10% sell-off? Yes, that's possible. I mean, if the global markets were to become very nervous about what's going on in the Middle East, if that escalation of that conflict goes beyond the localized trouble that we are seeing in Israel at this point in time, something else can happen given a lot of uncertainties around interest rates and the accidents that may cause, at the rate at which rates have gone up in the Western world. I mean, all these are signs of danger. But till the domestic investor sentiment is intact, I don't see a significant sell-off. It's puzzling because there is just so many uncertainties out there, and the domestic investor is still very, very comfortable. But it is what it is, so we have to deal with it. And I hope there is no domestic event that leads to a massive sell-off. International events we'll have to contend with as they come along.
How are you feeling about the auto sector now? Because, there is this big demand push that's taking place and raw materials have cooled off as well. Markets like the rural markets have come back and, even companies from the two-wheeler space, which was the most affected, right? They're talking about how there is a recovery in demand. As an investor, how are you feeling about it?
Sonia, I'm obviously feeling a little bit more constructive now looking at the data. But whether this demand revival sustains or it is just a very near-term phenomena for the next 2 or 3 months, given it's the festive season, and you're coming on the back of multiple years of no growth in the two-wheeler area, I'm unable to parse that because the readings that I'm getting on rural demand are very mixed. There are a whole bunch of areas where one continues to see fairly tepid rural demand. So the two-wheeler might be an exception given by a forced renewal cycle after so many years of slow growth, or is it something deeper? I'm not able to make out. On the premium auto side, whether you're talking about mid-size SUVs or small-size SUVs, or you're talking about premium cars, I think there is a lot of traction there. And the urban demand in that area is extremely strong. So, some of the car makers and some of the premium two-wheeler automakers are continuing to see a lot of traction. And that again feeds into the whole, the rich are doing well narrative that I spoke about earlier.
All right. We'll let you go on that note. Ashwini, thanks a lot for joining in.
Thank you.
And have a great day. Thanks for giving us your thoughts on the markets. Well, let's focus on IRB Infra because the company reported a steady September toll collection growth. In fact, Q2 toll collection was up 22%, coming in at 1,200 crores. Also, there is some more, positive updates on the company. They expect a 10 to 15% growth from the EPC business. To discuss this and more, Anil Yadav, who's the Director, Investor Relations and former Group CFO of IRB Infra, joins us now to talk about that. Anil, thanks a lot for joining in. I want to start with the toll collections itself. This time September went up by almost, 30%. You're sitting on a base of about 420 odd crores. What is the average run rate, monthly run rate that you hope to see in toll collections over the next many months?
Thank you. We have witnessed 28% growth in the September month. And if you look at the private InvIT alone, there the growth was close to 35%. And IRB asset, which has Mumbai, Pune and Ahmedabad, Vadodara, there growth was 21%. If we look at Mumbai, Pune alone, there the growth was 25%. And now the festive season is starting in India. On the backdrop of the festive season, the traffic growth should improve from here on.
All right. Hi, Anil. Good morning. So what could you guide us in terms of a number? What could that look like? And also give us a sense about collections.
Yes, with respect to collections, if we'll talk about the September month, Hyderabad ORR has started from the August, and full impact of the Hyderabad ORR will be visible in in the Q3 and Q4. And we are about to start Samakhali project. Both Hyderabad and Samakhali will contribute in Q3 and Q4 from here on. So that will be the additional revenue will be coming in. Apart from that, we will see around 15 to 16% growth in terms of the existing assets also, because Mumbai Pune had a 17% tariff revision, both corridor put together, and around 7-8% kind of traffic growth on Mumbai Pune, which we have witnessed in the September also. The overall growth on existing portfolio should be in range of 15 to 16%. Plus, if you add the Hyderabad and new project coming in, the growth momentum should continue in the coming quarter as well.
Okay.
All right. Got that. Then you're expecting growth momentum to continue. But Anil, give us a few more details then. Give us a sense of how the private InvIT activity is panning out. Are you on track for the 2,500, 2,600 crores of revenues, as well as EBITDA of, I think, 1,500 to 1,600 crores for this fiscal year?
Private InvIT, what you have talked about is only for 2,500 to 2,600 crores is revenue only for the 10 assets which were there at the beginning of FY24. So that includes the first 10 assets. Thereafter, we have added Hyderabad ORR and Samakhali will get added. So then definitely from 2,500 on annualized basis, there should be another addition of roughly 800-850 crores of revenue on top of that. And EBITDA of around 1,500 to 1,600 crores, another 700 crores of EBITDA should get added once this project starts contributing. Hyderabad has already started. Samakhali is about to start. So Hyderabad alone itself will provide an EBITDA of roughly 600 to 650 crore rupees.
Okay, Hyderabad will provide an EBITDA of 600 to 650 crores. Got that. I wanted your thoughts on this 18% GST that was, proposed on corporate guarantees for subsidiaries. I wanted to understand for infrastructure players like yourself, what could the implications or impact of this be?
I think with respect to this corporate guarantee, whatever provided, overall, it will not have any major impact because anyway, IRB does the EPC and there is a cash outgo every month on account of GST. If the SPV, if we will charge to the SPV, we will get an input credit for the same. And secondly, anyway, today you are charging for the EPC. So to that tune, EPC can reduce by 1% and that you can charge by way of corporate guarantee. I don't think so. It will have major impact for players like IRB, which has integrated approach that we do a construction for subsidiaries as well and also provide the corporate guarantee for the same.
Okay. And for this, the InvIT holders, right, the publicly listed InvIT holders, is there any plan for any kind of dividend payout? Because now you have sort of reduced your debt is paid off as well. So will the payouts increase for InvIT holders?
As of now, we are guiding around 8 rupees per annum payout. And as and when the payout will improve, definitely we will share those data. But as of now, we are guiding only for 8 rupees payout per annum.
All right, Anil, what about raw material prices? I track cement very, very closely. And the sense is that, prices are expected to go up from here. That could be a bit of an issue for you, right? How do you see things panning out? Because cement prices holding strong. The hope though is that we're getting to a general election and there'll be some kind of cap that will put in place. Tell us how you're reading the situation.
I think before going to the EPC side of the business, I would like to add on the private InvIT. We have got a sanction of 6,400 for 5 of the SPV of the private InvIT. And we are there moving the debt from SPV level to the trust level. And there will be a roughly 115 basis points saving on the interest cost and almost 15% saving in the amortization over the period of 5 years. So last year we have refinanced a couple of projects and saved almost 500 crore cash flow over the period of 500. And for this 5 project, the saving will be almost 3x, and which will be close to 1,500 crores, close to 1,000 crores on account of amortization, and roughly close to 500 crores on interest saving. Now, moving to the EPC side, we have a large portion of the EPC which comes from the O&M. So we expect stable revenue from the EPC side, and probably the second half revenue should improve. And we also provide the key raw material which is required for the road construction in our corporate presentation, that is cement, steel, and bitumen. And if you track the last 12 to 18 months, we have not seen any major increase in the prices. Prices has either reduced or remained stable where they were up before 12 months or 18 months. Probably because of the prices remaining at the same level, probably we'll see a 100 to 200 basis point improvement in the construction market.
Just one final question, is there any kind of political pressure that one can expect on toll collectors ahead of the elections? Because there is, so much talk back and forth on making Maharashtra toll-free as well. From a toll collector standpoint, what would the implications be ahead of the elections?
I think we are in this business in the last 3 decades, and we have not seen any closure of the toll plaza. But we have a model concession agreement which provide adequate compensation, which talks about paying out for 150% of the equity invested, adjusted for the inflation in case of such eventuality. So we are well covered as far as concession agreement is concerned. But if you look out, India is looking for the expansion of the road grid. And so far, the project, whatever we have constructed or which are already awarded, roughly 1 lakh kilometer has already constructed or already under construction. Probably as per PM Gati Shakti plan, they are talking about 2 lakh kilometer to be constructed by FY 27 or 28. So then if we want to expand the grid almost equal size what we have done till today, then definitely that will require a private participation. And to attract the private participation in the sector, I think the government so far is doing that. They have never tried to tweak the concession agreement or make the changes after awarding the contract. Whatever the changes has happened with the prospective effect. Considering the such large pipeline, I don't expect that there will be any kind of issue in terms of the toll collection on overall basis.
Okay, all right. We'll leave it there. Anil, good to speak with you. Appreciate you joining in, and it's always a pleasure, having you here. The markets, bumping into 19,600 once again. So there was a bit of a give back, but not very much since. I just want to, before we take a break, highlight a few other names. We were highlighting Kalyan Jewelers, which was up 5%, but it's not just Kalyan, right? You look at something like a Tangamail Jewelers, which is up 5% right now. Volumes are not as strong as, of course, what Kalyan is seeing, but Tangamail is, I think, at a new high, almost at 1,400 rupees. Vaibhav Global, it's a different business model, but that is up about 4% as well. Stocks at about 425 in the imitation jewelry space largely. And then look at Tribhuvan Das Zaveri, which is TBZ. That is up about 5% as well. So this seems to be, a move across the, second tier 2 kind of jewelers. TBZ is up about 4.5%. It's been at least stock price wise, has been a dead name for a few years now. Let's look at Senco Gold as well, which is the latest addition to this list. Predominant in the eastern part of the country. That's done well since listing, and that is also up about 5%. So, this is a theme which is playing out quite nicely. 640 on that one. The other one is power, and we mentioned Genus Power right at the word go. That we had a 5% gain there. But look at KEC. KEC, I think, is up about 4%. Skipper Limited is up about 4%. And you've got a few other names here from the space also, which are not doing all that badly. So keep an eye out on the other sort of theme there, which is power. But the big one, of course, is these smaller jewelers, but not really smaller. Kalyan is not small, but these jewelers doing quite well. We'll take a quick break here. We are back. we shine the spotlight on the insurance space ahead of the second quarter earnings. We'll have Madhukar Ladda, Director of Nuvama Institutional Equities, joining in to talk about expectations in the second quarter from the sector. Stay with us.
Welcome back. Well, the markets are holding with gains of close to around 85 points or thereabouts. Remember, the 50 DMA on the Nifty comes in at around this 19,600 odd. But it's been a good first half hour, actually. The Nifty Bank as well has crawled its way above that 44,000 odd mark. Yesterday, it came in for a hard knock. And the breadth of the market is looking very, very good, with 8 stocks advancing for just 1 stock that's declining. We have with us Mr. Madhukar, who joins us to help us out with a quick analysis on what we expect from the insurance space in the coming quarter. Hi, Madhukar. Good morning, and thanks so much for joining in. Well, tell us the key points that you're going to be tracking, for the coming quarter.
Sure. So, coming quarter, growth has definitely improved in Q2 versus Q1. So that's a positive. But in terms of product mix, I think for the life insurers, the growth is driven more by ULIP, with markets doing well. I think what will be important to see will be, how individual protection is growing and whether non-par products are holding up in the share, given, the interest rates have moved higher for other sort of products as well. So, and finally, on the margins front, I think broadly the street does expect slightly muted margins on a year-over-year basis. So anything, my guess is more than maybe about 200 basis points will be taken as more negative. Yeah, broadly these things would be watched out for in 2Q for the life insurers in particular. Yeah.
Madhukar, hi, good morning. Let's talk about it one by one, right? I want to discuss what's happening with HDFC Life because, it's been a good start to the year for that company. If you look at the numbers, right, the individual AP grew at almost 10%, almost double digit. The total AP went up about 14% and compounded, if you look at it, the individual AP has grown at about 15% in the last 4 years. But this stock is just not doing anything for investors, and it's been a frustrating 3-4 year period where HDFC Life has done nothing. Your thoughts on what the way forward could be?
So I think in relatively probably about 3 years back, I think the growth was a lot stronger, and it was the only sort of dominant player in the HDFC Bank channel. So since then, a lot has changed, and the valuation that the company was getting was a lot higher. Post that, actually, right now, the competitive intensity in the industry is also much higher. Their growth rates have come off. Having said all of this, I think it's still a solid, rock solid company. They're the product innovation leaders in the market. I think the brand inspires a lot of sort of confidence and faith from buyers of their products. So still, I think the company is pretty good. Having said that, I think right now what will be a key monitorable is after it has become a subsidiary of HDFC Bank, how much more support can it get from the bank? I think that's a key monitorable. So, broadly the sense is that the share of what HDFC Bank sells between, Tata, Birla, and HDFC Life share is closer to about 55-57%. And the street expects this to move a lot higher. Let's see, if that plays out, I think the stock could see a re-rating from here. I think that'll be a key monitorable for the stock, yeah.
But that's still your top pick, Madhukar?
My top pick would be SBI Life. I think.
SBI Life. Okay.
Yeah, they on a valuation basis as well as the growth that they're showing and margins that they have. I like SBI Life the most right now.
What about sort of general insurers? The devastation caused by floods in Sikkim and the damage to some of the hydroelectric power projects. Have you looked at? I mean, who's the insurer? Will that cause any damage in the listed space?
See, sort of, plant-specific details, I don't have that. But broadly, what happens is when these are sort of large plants, which are insured, then almost the entire sort of industry is carrying some bit of the risk, and which is again then reinsured, right? So these things do happen, and they do impact the quarter as such. But insurers have cat loss reinsurance, etc. So they get largely sort of reinsurance coverage of there, and it's not that it normally does not work out to be that bad. This quarter for general insurance is expected to be better because what happens is this is a seasonally stronger quarter. A lot of the business gets written in Q1 and the expenses are upfronted in Q1. So this quarter then the expenses are lower, so your underwriting surplus looks better. So in that sense, Lombard, we are expecting sort of better numbers. Yeah.
Okay. Madhukar, one of the things which has not been discussed very much is the implementation of the new the accounting norms, Ind AS norms, right? Which is comparable to IFRS 17.
Right.
And I think the regulator wants that to be implemented from the 1st of April 2024, which is pretty soon.
Pretty soon, yes.
Have you looked at this in detail? Will this make a big difference? It will change things in terms of how you account for premium received, how you account for expenses, etc. But briefly, what are your thoughts? Yeah,
I think two big changes. I think, and within that also, I think the biggest change is going to be the deferment of acquisition costs. And once you allow for that, then you really don't need to get into the concepts of VNB, etc. So to that extent, what happens is that the accounting profits are the basis on which you could value most of these companies. And the accounting profits would improve. The ROEs would broadly sort of go up. And my sense is that the life insurers would see ROEs of between 16 to 21% or depending on which company it is. And general insurers, the impact is a little lower because normally the business that they write is just 1 year, so the deferment of acquisition costs is there, but benefit is slightly more muted. It's much more for the life insurers. And over there as well, we'll see some improvement in ROE and profitability. So you could expect about 200 basis points, 200 to 300 basis points sort of improvement in ROEs for the general insurers and health insurers as such.
I just had a thought that I wanted to put forth to you on ICICI Pru, right? iPru has been underperforming its peers for a while. I mean, if you just look at the numbers, the APE growth this time was barely about 4% in the individual APE I'm talking about. Overall APE growth was actually a fall of 1%. Why is this underperformance there, and what is the expectation in Q2?
So, couple of things. It's a well-known fact that ICICI Bank is sort of not selling few and a very large portfolio of products in life insurance, right? So a bank partner which used to contribute almost 55% of iPru's APE, 3 years back, is now down to just about 15% odd. So again, a principal bank partner is very important. I mean, life insurance, each of the other listed life insurance companies have a primary bank partner which is contributing significantly to their sales. So I think over the last 3 years, you've seen that rundown happen. So business has declined from that channel, and they've had to sort of develop other channels. So the focus has more been on agency and other banking partners that they've acquired. My sense is large part of the ICICI Bank channel decline is now played out. It will probably stabilize at these levels. And what was disappointing is that the other partners, AP growth was just about 2.5% even in the last month. So while July and August were slightly sort of better growth months for the company, September disappointed a little bit. And lastly, also on the group side, group AP contributes almost to about 18 to 20% of their top line. I think that is a fairly competitive business, especially the group term insurance where iCruise is present. And I think they'll also see some pressure over there, some top line pressure over there. Finally, on the margins, I think margins are also coming off for them. There were tailwinds with, the non-par products growing last year, and also tailwinds in group term insurance. So all those are also sort of going away right now with the shape of the yield curve, etc. So I think that's going to be my sense. It'll probably underperform a little bit more, and then do better. Once the entire thing is in the base. Yeah.
Got it. Good conversation, Madhukar. Appreciate you joining in, and thank you very much for running us through your views on the entire space. Very useful. Let's talk about markets, right? From a technical perspective, though, it's our special segment, Charting Trends. We have Sachinandan Utekar, Assistant Vice President, Technical Equity at Trade Bulls, who's joining us now. Thanks very much for joining us. Just a quick sort of, look at the Nifty itself. The views are pretty diverse. Not just from a technical perspective, but from a fundamental perspective as well. Many that we speak with, especially on the institutional side, believe that things are, looking, risk reward is not exactly all that favorable, or the downside may be limited. On technicals, also, I mean, we've seen slightly slight pullback, but hasn't really amounted to very much. Do you have a firm conviction in terms of which way we are headed, and what's the sense? Go on, Nifty first.
Good morning, Prashant, and thank you for having me on the show. Clearly, when we look at some of the major trends in Nifty, the conviction still remains high. And, the exhibit which I've shared in front of you is the Nifty monthly chart for the last 10 years. Now, we've given a lot of emphasis on this particular indicator called ADX, and the way it is placed on its monthly scale is giving us that confidence that last 2 months, the kind of volatility that we have seen, the kind of corrective that we have seen so far in this particular current series, I think this entire correction should be absorbed, and probably we may see Nifty again trending on the higher side. So if you look at the exhibit in the third panel, where we have noted the indicator 2, the ADX has just crossed that 25 mark. Now, whenever this particular thing happens, it is a good conviction that has been seen in the following months, wherein the Nifty starts trending and continuing its higher top, higher bottom sequence. So if you look at the last 3 incidents as well, when we look at the history, a very similar setup was observed in July 2014, when the RSI was at around 77, displaying a very strong overbought kind of scenario. And during this particular month, we saw the ADX, crossing that 25 mark. And post that, I think the Nifty surged from 7,700 towards 9,000 levels. So despite the RSI giving a overbought kind of a reading, wherein there are diverging views which are exhibited in the market because of the overbought condition, ADX is an indicator which purely guides us wherein the directional strength is still sustained and whether it can be sustained in going in the immediate future. So here, we have seen a very similar phenomena in 2017 May. Again, a very overbought kind of condition when it comes to RSI, but the ADX had just given a breakout from the 25 mark, and post that we saw that continuation of higher top higher bottom sequence, and very similar exhibit in January 2021. So I think this is just a repeat of what we have seen so far in the last three instances when it comes to 10 years time scale. And even right now, we are of the opinion that before December 2023, we may see Nifty again scaling towards 20,600, 20,400 kind of a zone, and eventually we may see the next year Nifty scaling towards 21,400. So the setup is looking promising. We have already seen a good consolidation and a healthy correction, which should be bought in.
Got it, got it. So there's a good consolidation, healthy correction, and the the way forward is northwards, right? Got that. Which are the leaders of the market, of the next leg of the rally?
Good morning, Sonia. Sonia, I think one pocket that we are targeting is Nifty Realty, and if you look at this particular sector, again here, if you look at the ADX, the placement is very promising. We saw a very similar kind of a breakout from a rounding formation in the month of May 2017, wherein the ADX had just jumped above the 25 mark. The entire pattern unfolded a price target of around 50% on the higher side, and we have a very similar exhibit with the breakout that was recently exhibited at around 520 levels when it comes to Nifty Realty. Post that, we have seen one particular leg on the upside, but even right now the conviction is there that we could see this particular index itself scaling towards 750. Now, this is the pattern target of the rounding bottom formation that we have seen from September 2021. The accumulation was done well. We have seen a price surge and a consolidation now. So probably the next leg of the rally is evolving here, and we may see a good, sustainable move when it comes to Nifty Realty. So we are optimistic on this particular part.
Okay, all right. And if you're optimistic on the Realty Index, you'll have a couple of stocks from that pack itself that could look up, Sachi?
Well, Nigel, I think the focus still remains on DLF, and the weekly structure has been very clear. It has been respecting its 5-week exponential moving average well. Last week we saw a good healthy consolidation breakout. Now, if you look at the candlestick formation, it exhibits a rising 3 formation, which is a very rare continuation pattern when it comes to candlesticks. And if you look at the basic wave structure and wave counts, it purely looks like a breakout from a flag formation. So even from a trading perspective, we have been recommending, buying into DLF. The reward to risk opportunity is also good. We have a good pattern support to trail our stop losses. So even at this juncture, keeping a stop loss somewhere close to around 510, we may see a DLF scaling towards that 590-600 mark.
DLF scaling to that 590-600 mark. Okay, so those are interesting charts that you've put out: Nifty, Bank Nifty, Real Estate Index, and DLF. Sachiran, any other ideas you want to present? Positional ideas, which you think are good to go from here?
One particular stock that we have been tracking, and it has displayed a breakout today. A very similar structure to what we discussed in DLF is Bharti Airtel. Now, if you look at the last 3 weeks of consolidation, we saw a bullish pennant kind of structure there, and the stock was unable to surpass that 930, 940 cluster. So we have seen a good breakout in today's session, and that's why we have also recommended trading momentum to our clients through this particular counter. we are expecting that the broader picture still remains very robust. We may see this particular stock scaling towards 10,020, 10,040 kind of a zone. And right now, probably one can still add on to their longs with a stop loss at around 920.
Okay, I think for Bharti you meant 1,000, right? You said 10,000.
1,040, yes.
Oh, 1,000.
I actually didn't mean 10,000.
All right, thanks a lot for that, Sachi. Appreciate your thoughts here on CNBC-TV18. Well, the market is looking good. 19,600 is holding. A lot of stocks in focus. Mazgaon Dock, Kalyan Jewelers, Escorts, Delivery. List is pretty endless. Phoenix Mills all up anywhere between 3 to 6%. So demand has come back. Let's slip into a quick break on that note. But when we come back, Manisha will be joining us to tell us what's happening in the world of commodities. Stay tuned. Welcome back. Let's get a quick handle on what's happening in the world of commodities. Manisha Gupta is here with us. Manisha, what are you tracking?
Thank you for that, Sonia. Well, we've been talking about the crude oil prices, but let's not lose sight of heating oil, natural gas, the crude products, that is, and those have been inching higher as well. So I'm talking about the natural gas prices, where in the US markets, we are now trading at around 8-month high. If you look at the last 1 week moves itself, we have seen the natural gas prices gain up by 14%. If you look at the European natural gas prices, those gained 15% overnight. And there are various concerns. The reason that you have seen such big surge come in for the energy prices there. Well, to begin with, we have seen the crude oil prices firm up from the low of nearly $85, $86 in the previous week to 88 plus kind of levels right now has been supportive for the natural gas prices. Add to that the fact that the Chevron Australia facility could be looking at labor resuming strike there. So that means the gas production there could decline, and that has been supportive. Israel also has taken a call to shut the Tamar gas facility because of the kind of war that's raging there, and the concerns that, that place could be hit is the reason they've shut that place out. Apart from that, there also is leak reported at around the Estonia gas pipeline. So that has led to lower pressure and lower gas flow into Europe. And that's the reason you've seen those prices gain up. Also, when you look at the US markets, and they have been the biggest exporters of gas in the last couple of years now, the production in US has continued to decline while the exports continue on a firmer note, is the reason you are looking at the US gas prices as well rising up. So whether it's about US, Europe or UK gas prices, we have seen a strong surge come in last week, 10 days. This is how the gas prices have behaved in this year. We started on a higher note at 3.6. That is a time when you were looking at winter demand concerns coming in. But somewhere in the month of April and May, we saw the prices decline by half to nearly $2 per MMBTU. In the last couple of weeks or so, we've seen prices gain up quite strongly. 3.3 is where we are trading right now. Markets do believe that with the winter demand coming in, we still have the hurricane season going on, and lower situation coming in from Russia to Europe as well are some of the factors that could keep the gas prices in favor.
All right. Thanks a lot for that, Manisha. Well, Escorts is one of the stocks that we're looking at this morning. The stock is up almost about 3% odd. DAM Capital has raised their target price on Escorts substantially to 5,100 from 3,150 earlier, and this values the company at 30 times FY26 earnings. They talk about how there are significant synergies on the merger of Escorts and Kubota that will start to flow through. There's market share expansion through these synergies. There's strength of each brand. They are filling a lot of the product gaps as well, both in the domestic as well as in the export market. And there is margin expansion that they are expecting because of operational efficiencies and localization. They also talk about how exports are growing at a healthy pace because of some new products and capitalizing on Kubota's global network. But I reckon one of the other reasons why the stock is up is because of the news break that, we had a couple of months ago, which is not confirmed yet, but in all likelihood, Escorts will be selling its railway business. They are looking for buyers as well, and that deal perhaps could go through over the next 1 month or so, and hence the street is quite optimistic that they are selling a part of their non-core business and going to focus strictly on the farm equipment business. Hence, this is a big mover today. But Surbhi is with us. She has a couple of more stocks on her radar. Surbhi, what are you looking at?
So I'm looking at Genus Power. Now they won 2 orders worth 3,100 odd crores for appointment of advanced metering infrastructure service providers. Now this is basically to supply, install and commission close to 35 lakh smart prepaid meters. And the next one on my radar here is Muscat Dock. They have signed a letter of intent with a European client. This is for construction of 6 firm and 4 optional units of multi-purpose hybrid power vessels. The price will be firmed once they sign the contract. So currently it's just the letter of intent and there is no pricing which has come out as of now.
Okay, thanks very much for that. But Surabhi,
let's take we can take a quick break.
Commercial break here. I think we're up 100 points. 19,611 is where we're at. So after spending from the opening time at 9:15, I mean, we actually opened into the 19,605 level, which is the 40-day exponential moving average. And kind of toying around that level, spending the last 40-45 minutes around that level, there is a move higher which is coming. So, you cross this, stay above this, you get visibility all the way till about 19,723 or so, which is the next important kind of pivot level. So let's hope the gains stay over the next many hours. So we'll take a quick commercial break here. We'll come back. My colleague Lata will get chatting with Gautam Dugar of Motilal Oswal Financial Services. They'll decode what to expect from the second quarter earnings season, which is right in front of us. Stay with us.
Well, the results season is going to well and properly hit from tomorrow when TCS announced its numbers, though today we have GM Breweries. So it's a very good time to look at the results season ahead. And we have perhaps someone who's best in the business, Gautam Dugar, the head of research institutional equities at Motilal Oswal Financial Securities. Gautam, thank you very much indeed for joining us. We have tried to put out as many takeaways from your huge, 130-page report, earnings preview. Well, one of the first things that intrigued me is that it's a damn good earnings growth. Nifty companies 21%, MOFSL universe 40%. But it looks like much of it is only because of the OMCs. If you remove the OMCs, it's a okay kind of earnings season. Is that right?
Lala, good morning. Thanks for having me. I won't call 20% growth is okay, because even if you look at my coverage without OMC, we're still talking about a 20% growth, right? So last quarter, we had 52% growth for our coverage. Without OMC, it was closer to 30%. Even last quarter, Nifty was 32%. Without OMC, it was 18%. And this quarter, as you rightly pointed out, we are penciling in a 21% earnings growth on Nifty. And without OMC, I think it is somewhere close to 15%. So very strong performance, Lata. It's coming on a very high base. If you look at Nifty's earnings over the last 3 years, they've compounded at 23% from FY20 to 23. So on that base, not only are we talking about a 20% growth for this particular quarter, we're also saying for a full year growth also, it is somewhere about 22%. So it will be very strong corporate earnings for FY24. Whichever way you slice and dice it, you look at X financials, X commodities, or X OMCs, numbers are looking very strong overall.
No, I just went by this X OMCs. You see 15%. It kind of took away the shine from the earlier big numbers that you threw at us. But what was most shining about your entire report? The earnings growth for MOFSL's mid-cap universe and small-cap universe, that's 104% increase. I mean, that's big. So do you think that we have to look for some very sparkling performance in mid and small caps now?
So, Lana, I will take that with a bit of a pinch of salt always, because there are a lot of base-related effects. There are a lot of commodities which are part of mid-caps and small-caps. They're not part of Nifty companies. So you have to look at mid-cap, small-cap earnings always as a trailing 12 months average rather than get, worried about 1 or 2 quarters of a very strong performance, because there are many base effects which are at play right now. For example, if you look at cement sector has had a very horrible run for 7 quarters in a row. The last time cement sector in our coverage universe reported earnings growth was in September 2021. After that, there have been 7 consecutive quarters of earnings decline. And this quarter, we are seeing a 72% earnings growth on that extremely low base. Right? Similarly, OMCs, we are talking about some earnings doubling, tripling there on a YY basis. But markets will look beyond that, right? Because things can change very rapidly in those very volatile and cyclical segments. But yes, if you just look at the categorization for this particular quarter, you're seeing a very high base, high growth in both mid cap and small caps.
Okay. All right. Let me come to the overall picture itself. It looks like this is going to be more a margin and EBITDA driven quarter. Sales is not what you're looking at.
So, Lada, look at it in this way. Overall sales growth is somewhere close to 6 to 9% in different set of aggregates. But when you look at sales growth X of commodities, it is about 13%, which essentially tells you that X of commodities, the sales growth is still very robust. Why is it depressed at 6%, including commodities? Is because of a very high base for commodities in the base quarter of September 2022. So that is why if you look at aggregate sales for Nifty and our coverage, it will give you a very different sort of a picture than what actual the underlying reality is. Yes, there is a broad-based margin expansion across the sectors. Auto, once again, the fourth consecutive quarter, where it will turn out to be the best performer in a variety of sectors that we cover. You are seeing good margin expansion as we discussed in cement. Same is the case for consumer. You're seeing margin expansion in metals, oil and gas. The only sectors where margins are expected to remain very flattish is healthcare and IT. At an aggregate basis, we are talking about a 350 basis point of a margin expansion for both our coverage as well as Nifty excluding financials, right? So yes, this is a quarter where the margin expansion is very broad-based, which is why when you talk about a sales growth of 6-7% and EBITDA growth of somewhere about 18 to 20%, that is what is clearly evident, that the operating profit growth is clearly led by margin expansion, because volumes in many sectors like consumer are still very, very tepid. In some other sectors like cement and auto, they are healthy, but in consumer staples, you're still seeing volume trending very low.
Oh, okay, so that would be a point of bother. Yeah, as you pointed out, autos 87% YOY rise in earnings and cement are likely to be the standout sectors. Do you think we can be surprised even on the upside? Is there any sector that's going to really dazzle?
So
better than your expectation?
I think possibly auto can surprise again, because see, auto, there is a bit of a history. For FY18 to FY23, the earnings went nowhere. You know, the auto profits of FY18 in Nifty companies was 28,000 crores, and it was 28,000 crores again in FY23. Between FY23 and FY25, we are talking about profits doubling for auto sector from 28,000 crores to 57,000 crores. It went through 16 consecutive quarters of downgrades. And now last 3 quarters, we have seen consecutive upgrades. The December quarter, which is basically the January result season, April and July. And even in this preview, we marginally moved the numbers upwards for auto sector. So it is having a very good time right now, both from a volume as well as a margin perspective. And given the element of operating leverage which kicks in, you tend to get surprised on the upside. And when things were bad for them for 4 years, you were getting surprised on the downside. So auto is something which I will say one sector. Second is PSU banks. I mean, we have seen banking sector. When I said the auto went through 5 years of a horrendous time, this is exactly the when banking profits went up 5 times in 5 years. And even that expanded base of 212,000 crores of profit which they delivered in FY23 for Nifty 11 BFSI companies, we're talking about a 27% growth in financial earnings, though it's not linear. Every quarter you will see moderation in banking growth now, right? So 1Q was the best, 2Q was slightly lesser, and 3Q and 4Q, the growth will moderate even further. But on aggregate for the full year FY24, you're still talking about 25-27% growth in financials, which is very strong.
Oh, yes, no taking away from that. But yeah, important that we've already seen the best quarters for banking and finance. Margins are likely to be under pressure in the results that will come in the second quarter. Now, let's discuss about prices, Gautam. You know, your Nifty EPS for the current year is almost 1,000 rupees, 986, which means we are 20 times. I mean, at the moment, it's very easy to divide. 20,000 Nifty, 1,000 rupees EPS. So we are at 20 times. Is that an attractive place to buy at all? You know, there are people who argue that in good times we have traded for a goodish bit at 22 and 23. And so, you know, there is still reason to hold on.
So I think when you look at numbers now, you have to move forward on 12-month basis, right? When you talk about 986 is the EPS for March 24, which is just 6 months away, right? In another 3 months, markets will move on FY25, right? So where we are at around 1130 rupees. So let's say one quarter down the line or 6 months down the line, if you're discounting FY25, I'm just giving you maths. I'm not making any predictions. Let's assume that this 1130 rupees of EPS stays intact. There's no downgrade, or maybe it moves down to 1100. And the current P, which we are talking about, 20 sustains. So if you just do the maths, 20 times 1100 gives you 22,000, which is the calculation for Nifty. Let's say the numbers look very optimistic and something happens globally or domestically, which pulls the market EPS down by 10% from where we are today, 1130 to say 1050. If you're talking about 20 times on that number, you're still talking about 21,000. So if this earnings growth is very critical, if you look at last 3 years when Nifty compounded at 23%, Nifty gave you 27% compounding between the similar period. And I'm not just singling out Nifty. You look at NSE 500, so almost represents 90% of the India's market cap. NSE 500 is an index earnings compounded at 28% for those 3 years, and the index gave you 31% compounding. So ultimately, end of the day, what matters over a period of time is corporate earnings. Everything else, macro rates, news flow, geopolitics, it falls by the wayside over a period of time, right? So corporate earnings, if they stay intact and this 986 and 1130 is delivered, you still have a decent, goodish bit of upside. As far as valuations are concerned, if you look at a 10-year average of Nifty PE, we are at about 20 times. If you want to take a very bearish picture and say, I want to look at 20 years of PE, then 20-year average is somewhere close to 17.5, 18 times. So if you compare versus 20-year average, we are 10% expensive. If you're comparing versus 10-year long period average, we are bang in line with the long period average on Nifty. The problem is in mid-cap and small-cap indices, which are very expensive. And especially mid-cap index is trading at about 15 to 17% premium to Nifty and its own long period average.
Can you leave us with one or two stocks where you see huge valuation gaps?
Sorry, can you come again? I missed.
Valuation gaps where, you think the market has not yet caught on to a good stock. Can you leave us with some stock ideas?
So my stock ideas are there all over in the model portfolio. But if you are talking about sector, I would think banking is looking very attractive from a valuation point of view. A sector has delivered excellent earnings, but the underlying market cap has not kept pace with it for a variety of reasons. Maybe the sector is overowned. Maybe people are concerned about the margins. Maybe people are concerned that the best of the cycle is already behind. But if you see my allocation in the model portfolio, our single largest overweight is still PSU banks and NBFCs. Then we have a significant overweight stance on consumer discretionary. Out of the 8 consumer stocks that we hold in the model portfolio, 7 are consumer discretionary, where conviction is very high on Titan, Indian Hotels, Zomato, and DMart. Right? And then we have been continuing with our large overweight stance on automobiles, where we have positions in Mahindra & Mahindra, Ashok Leyland, Bharat Forge, and Craftsman Automation. And this revision, we marginally increased the weight on pharma, made it overweight from neutral, where we added Cipla and Medanta. And yes, last but not the least, definitely industrials, which has done phenomenally well over the last 2 years. There, the big overweight continues with L&T, and incrementally, we've added Bharat Electronics. So that's the published model portfolio.
Okay, that's a great summary of all the stocks that you have recommended. Thank you very much, Gautam, for joining us. We will look forward to how the results season pans out starting tomorrow. TCS. Wrap up on Bazaar on that note. Chartbusters up next.